All right, welcome to this third part of private real estate investments. Mr. Mesh here. I hope you guys are enjoying this section on private real estate. It's actually quite interesting stuff. Not too complicated, a bit of a challenge, but something that is enjoyable. So I hope you guys are enjoying. In this section, we're going to look at private real estate due diligence, as well as private real estate valuation using scenario analysis. Let's jump right into this and start with the due diligence of private real estate. In terms of due diligence, we consider the market review and outlook, and this basically is a guide on demand forecasts. So the important part on the market review outlook are the demand forecasts. In this instance, the investor is going to focus on things like the prices, construction costs, and economic factors, which are then used to estimate the economic potential of the property. The investor is going to consider whether the property is going to be income producing, or opportunistic. Where your income producing property, you are going to be collecting rentals, for instance, and opportunistic, this is based on distressed real estate, where you refurbish and then you put it on the market, sell it at much higher value and make money out of that. The developer and contractor review, investors are going to rely on the collaboration. So in this instance, the investor is going to rely on the collaboration of the developers and the suppliers. If they are collaborating well, it means the project is going to run smoothly. They also consider the reputation of the contractor. This is important. They look at the history of the contractor, they look at the track record of the contractor, they look at the experience of the contractor as part of the due diligence, and whether or not they align in terms of safety with the laws of their operating area, and also they take into consideration things like liability insurance. For the financing plan review, the investors come in different forms. You have the debt holders and you have the equity holders. And these take different focuses. For instance, the debt holders are going to focus on things like the costs, the financial leverage of the firm, or the project timing. In terms of the project timing, remember, when the project starts at inception, usually the GPs are going to get a construction and development loan, which is short term. And then at the project completion, they're going to convert this construction and development loan into a long-term mortgage. So they convert this into a mortgage, and this mortgage is longer term as compared to they take the mortgage, which is long term, and pay off the construction and development loan. In terms of equity, the equity holders are going to consider the risk versus the return. Bear in mind that with regards to equity holders, they have a lower priority of claim as compared to debt holders. Debt holders get a priority in terms of claiming the assets of the firm. So should the project become insolvent, the residual value of the firm is given to debt holders, and the equity holders, they get nothing. Hence, the equity holders might have to consider in their review a scenario where to salvage their investment, they have to inject more money into the business. They have to put more money into the business. So they take this into consideration during the financing plan review. And then the fourth aspect of a private estate real estate due diligence is partnership agreement, legal and documentation review. And these agreements, they outline shareholder rights. So things like shareholder rights are outlined in these partnership agreements. And also, so the shareholder rights, and also things like your financial disclosures, any sale restrictions. The LP investors must then assess the trade-offs of earlier involvement, larger investments, or longer lockup periods. They are doing a trade-off to analyze if they want to lock their money up for a long period and get a higher return. Remember, private real estate investments, like most private market investments, these are done through a closed-end fund. And these closed-end funds, they are highly illiquid, they have lock-up periods, and their shares are not traded until a specific period has lapsed. Hence, the investors have to take this into consideration. Do they want to tie their capital down for a specific period of time in anticipation of getting a higher return, or would they rather use their money for something else and then join in later on, considering the different phases of the life cycle of the project? They enter later on and invest maybe in secondaries where the risk is lower, but also at that point in time, the return is also going to be lower. They take that into consideration. In this legal documentation review, that's where they also review the taxation, the potential taxation on their investments. And they have to review these taxes. Okay. With lease commitments and cash flow projections, remember, different properties have different types of income. So this is going to depend on the business strategy that the GP has taken. In some instances, you might have a single tenant. And in some instances, you might have a single tenant, or in some instances, the property could be pre-leased in advance. It could be pre-leased. Or some investors might take a speculative approach with no lease. So they speculate, which is quite interesting. I have a former colleague of mine who always used to say to me, he was into this building of stuff. He was building lodges, and I think later on put them on Airbnb. And he said to me, just build. Trust me, people will come. So he takes that approach and he just builds. And for some reason, the people eventually come and he gets returns on these things that he builds, without doing much of an analysis or due diligence. He just builds. Okay, so obviously, as a professional, it's not expected. You obviously have to do your proper due diligence. If you speculate, you must end up making an informed decision, because there's a lot of money that is at stake. Then property and project plan review. This is going to consider things like the feasibility studies. You want to see whether or not this project is feasible. So you do a feasibility study. Okay, you do this feasibility study and you see whether is this project going to be feasible or is it not going to be feasible. And also you do surveys to assess the properties, the construction plans. You check the construction plans, and also there's an emphasis on the reputation of the A&E firms. Where these are architecture and engineering firms. So the reputation of these architecture and engineering firms is very important. You want to consider the reputation of these firms. When you're doing a real estate project, you need the architects which are responsible for the designing and the plans of your project, and the engineers are the ones that are going to be responsible for the building of the project. Again, the coordination of the engineers and the architects is of utmost importance. In this coordination, you are going to be reviewing in your due diligence to make sure that the coordination is going to ensure that the project is completed in a timely manner, timely completion, as well as on budget. The completion should be timely and on budget. So these are the elements of private real estate due diligence. The market review outlook, where this gives you an idea or a guide of the demand for the real estate. The developer and contractor review, where you look at the collaboration between the developers and suppliers, taking into account the reputation of the contractors. Then the financial plan review, you consider the focus of the debt holders and the focus of the equity holders. Then your partnership agreements, legal and documentation review, where you consider things like your taxes, your shareholder rights, liquidity, and so forth. With, for instance, with your closed-end funds, you have lock-up periods and you have periods of illiquidity. Then with your lease commitments and cash flow projections, this also depends with the business plan that the general partner has taken. And with the property and project plan review, you do feasibility studies, you do surveys, and then you also check the coordination of the A&E firms, their reputation and their coordination. With the A&E, these are the architects and the engineers. You want to make sure that the project is completed in a timely manner and on budget. You have to make sure that we do not waste money. All right, so that's the due diligence. And in terms of valuing real estate, there are a number of approaches. It will obviously be prudent to do more than one approach to value your real estate, to come with a realistic value for your firm. But there are certain things you need to consider when you are using a particular approach in valuing your real estate. The income approach is going to be used where earnings are a primary driver of value. So, for instance, if you're having regular rental incomes, if you have regular rentals, which are your earnings, you can then use these rentals as current cash flows or future cash flows based on the economic use. Sort of like when you use the dividend discount model, you have dividends which are cash flows, and then you use those ones, or the free cash flow to firm and so forth. Then you use that as part of the income approach. With the direct capitalization approach, we have been using this one, where you simply divide the net operating income in a single period over the capitalization rate. But the assumption we make is that future earnings are going to be stable. So, for instance, your net operating income, you assume that in the next periods and the periods that follow, the net income is going to be based on a particular growth rate. Okay, if they are not stable, if these future earnings are not stable, then this could be a challenge. The cost approach is going to evaluate acquiring land and building a similar property. So you look at the value of the property, but on top of that, you also consider the value of that property after you've put a similar property on that piece of land, and this is suitable for new development. The sales comparison approach, this is going to apply if the income approach cannot be applied, and you just compare a similar property that has recently been sold on the market. You look at that market value, and if the property is similar to your property, you value your property based on the sale of that property. So this compares the subject property to similar properties recently sold and is used when income valuation isn't applicable. And you can also use the development life cycle, where you consider market dynamics, future real estate market conditions, and project phases, from the construction phases to the stabilization phases. So you consider the development life cycle when you are valuing your property. And the real options approach, this is considered when there is flexibility to adjust the investment strategy based on market conditions. So just remember this. The real options approach is going to be used if you're flexible in adjusting the investment strategy based on market conditions. If market conditions change, you wanted to make a residential property, then things change. Now you want to change it to commercial because there's a higher demand for commercial property. Then you adjust your valuation approach based on that. Okay. So these are the different valuation approaches. Now let's do a bit of exercises before we get to the scenario analysis. As always, what I expect you to do is to read the question, pause, and then after, give it a try. Even if you struggle, even if you don't get it right, when you come back to the video and we do it together, you would have you correct your mistakes. There's nothing wrong with that. So we want to calculate the present value of the net operating income over the 4-year holding period. And remember, to calculate the present value, always you take the cash flows and you discount them to this present value using a particular rate. In this instance, we are given a required rate of return, which is 12%. All right, so let's do this. I did this in Excel. You can try do them by hand. I think you can do maybe the first two. You can try calculate this first two as practice to see if you can get this answer, and you can get this answer as practice. Remembering that the net operating income for real estate is given by the effective gross income minus the operating expenses. So in this case, the effective gross income, I put the formula, I left my Excel formula here so you know what I did, which means to get this final value here, you see those figures with colors. The effective gross income is simply the gross income, right? The units, 1,200, multiplied by the square feet, the space, 1,200, multiplied by the number of months in a year, 12, multiplied by the average rental rate, this 3. So this is the effective gross income. The effective gross income, to get the effective, this is just the gross income. To get the effective gross income, you must multiply by the occupancy rate. In this instance, it's 95%. Now, this is the effective gross income. Then you subtract the operating expense, and we are told that the expenses are 30% of gross rent. And we said this is the gross rent from here up until here. This is the gross rent. So we're going to take the gross rent 1,200 times 1,200 times 12 times 3, and then 30% of that 0.3. If you calculate this, you should get this final answer here. Give it a try and see if you manage to get this. We have done this a couple of times. You should be able to do this with ease. Okay. Once you get all this, you get all these 4 cash flows in the same way. To get the present value of the net operating income is just discounting this back using the required rate of return of 12%. So it's just the sum from the first period to the fourth one of the net operating income from 1 to 4 divided by 1 plus the required rate of return to the power of I. We add them up until we get to 4, where this is given as 12%. So we are going to do this. You can add these up, or you can put them in a calculator. I think the calculator is going to be easier. The initial cash flow 0, just put 0 there because you are starting at year 1. This I'm not going to rewrite this. It's going to take me time. This is the cash flow 1. This is the cash flow 2. This is the cash flow 3. This is the cash flow 4. These are the cash flows. So with the cash flow 1, you put this 26 million, and then it goes on and on and on like that. And then your I, you are going to put 12%, and then you're going to compute the internal rate of return. You have I here, it's given the required rate of return is 12%. What you're computing is the net present value. So you compute the net present value, and you should get an answer of 92,891,653. 653. I hope you managed to get this. 92,891,653. That's the net present value that you compute based on these cash flows. Okay, we have done similar calculations in time value of money. All right, if you got this, well done. If not, just give it a try again. You should be able to do this. Okay, just practice calculating the net operating income. It's something that is important, and chances are they would want you to calculate this in the exam. Not the entire table because it's time consuming, but if you can calculate 1 or 2 of these values, then you're good to go. All right, let's go on to the next question. So again, I want you to give this a try, right? We want to calculate the terminal value based on year 4 net operating income and the expected price the new LP investor would be willing to pay for the property. So we are just taking the net present value and we add the terminal value. So give it a try, and then we'll do this together. If we go back a bit, what is important here is this constant growth rate of 2%, this rate of return of 12%. So we need the 12%, we need the 2%. This is our G, this is our R. And this year 4 net operating income of 33 million. So take note of these values. We're going to use them in the next question. So the terminal value is going to be equal to the net operating income in year 4 multiplied by 1 plus the growth rate. And then we divide this by the required rate of return minus the growth rate. The net operating income I showed you just now, it's 33,696,000 multiplied by the growth rate 1.02. We saw that the growth rate is 2%. Then we divide all of this by the required rate of return, which is 12%, minus the growth rate 2%. So the terminal value is going to be 343,699,200. We need to discount this because remember, we have these values here. This is the time, and time 0 here, time 1, time 2, and time 3. The terminal value for time period 4 is evaluated at this point. This is the terminal value. And because it's 4 periods ahead, it has to be discounted back because we are valuing our property. We are here. So we have to discount it 4 periods back. Hence, the property value in this instance, and the property value is therefore equal to the NPV that we got, which was 92,891, 92,891,653, plus the terminal value, because remember this is already the present value of the net operating income. And then we add the terminal value, 343,699,200. Then we divide this by the required rate of return, 12%, to the power of 4. If we add this, we then get 311,318,708. So this becomes our property value. All right, so just make sure that you have this net present value here, and then you add the terminal value. That's how you obtain the property value. Okay, I hope you managed to do this. Let's move on to the next part where we discuss private real estate valuation using scenario analysis. This is very straightforward, so don't worry. Even if you feel like you're getting a bit dizzy, drink cold water, come back, and let's do this. It won't take time. I'm sure in the next 10 minutes we'll be done with the scenario analysis. So scenario analysis is like calculating expected values, something that you are familiar with. So what scenario analysis does is it combines a base case scenario. In this instance, we have this base case scenario. And this base case scenario is going to be combined with the worst case scenario where there's an oversupply or a recession, and an expansion scenario where we assume that the economy is doing well. In this instance, we are saying the economy is going to do well with a 40% chance we are going to have an expansion. But there's also a 40% chance that nothing is going to change. And we have a 20% chance that we might end up with an oversupply and get into a recession. So using these 3 different scenarios, we calculate the property value the same way we calculate expected values. So the property value here, the property value would be equal to the sum from I is equals to 1. In this case, we have 3 scenarios, so it should be to 3 of the probability of each of these scenarios, your 40%, 40%, 20%, multiplied by the value of the property. Okay, you understand this notation. We're just saying 40% times probability of an expansion, plus 40% times probability that things stay the same, plus 20% times probability of a recession. This is what gives you the property value. So we're going to jump into this and do an example to put this in perspective. But like I said, it's nothing complicated. I'm going to put a few examples here. The idea is that you give it a try by yourself and then you see how I do it. We do it together. Okay, what we want to do here is to calculate the expected property value under 3 possible scenarios at the end of year 3 using direct capitalization approach and a required rate of return of 17%. So with the direct capitalization approach, it's always going to be the net operating income over the capitalization rate. So the property value for an upside, we are going to take the upside net operating income of 7,006,250. Then we divide by the capitalization rate of 17%. We must get 41,213,235. We do the base case scenario, the property value for the base case, and the base case is 6,412,500. Divide again by the capitalization rate. We should get a base case property value of 37,720,588. And then we do the property value for the downside. This was the base, this is the downside. We take this recession or oversupply value of 5,462,500, and then we divide this by the capitalization rate and we get 32,132,353. Okay, and then we now use the formula that we said. We simply, to get the eventual property value, we are going to get this probability of expansion, 25%, and we multiply by the 41 million for the upside, 41,213,235. Then we add, the next one is 40%, so it's 0.4. We multiply by the base scenario 40%, it's 37,720,588. And then the last one, which is the downside, the oversupply scenario, it has a probability of 35%, so it's 0.35 multiplied by 32,132,353. And then if we add this, we are going to get the property value. Put this in your calculator. The property value is equal to 36,637,867 Canadian dollars. This is our property value. Okay, and what you note is that this expected value, so this is an expected property value, right? Remember, it's based on probability. So this expected property value is less than the base case scenario, because the base case scenario is 37,700,000 and this expected is 36,637,000. But this is due to the high probability of a down case scenario. 35% is quite high. We have a high probability of a downside scenario versus the upside. The upside has a lower probability compared to the downside. Hence, we have the property value being the expected property value being less than the base case property value. Okay, so I hope you managed to do this. Like I said, it's not overly complicated. Let's give you another one. I know you love practicing. You enjoy this. Okay, so if we assume a purchase price of 22 million, determine the likelihood of the investor reaching or exceeding a 17% target internal rate of return. So this internal rate of return, we're going to calculate it using our financial calculator. And the cash flows that we need, I'm going to show them to you just now. We are going to go up. You see that the net operating income for the first year is 2.2 million. In the second year, years 2 and 3, it's 2 million. It's a negative. So these are the three cash flows that we are going to put there. And also, you need to take note of these values, the terminal values, for the three different scenarios where we got 41 million, 37 million, and 32 million. We are going to make use of these values here for the upside, downside, and this upside in the basic scenario. We need to get this. So I'm going to put this in a timeline to show you what I'm talking about. Let me put the timeline here. We said the money going out, we are buying this for minus 22 million in time period 0. We are buying this for 22 million. And then in time period 1, we are told that the net operating income is 2.2 million. That's time period 1. And then in time period 2 and time period 3, both of these are negative. We are going to get negative 2 million here. And also in time period 3, we are going to get negative 2 million. To calculate the internal rate of return, we are going to take this as the cash flow 0, take this as cash flow 1, we take this as cash flow 2, but cash flow 3, we take this value and we add the terminal value. We have to add this terminal value. And this is going to depend on the scenario that we're dealing with. Let's look at the upside case. So with the upside case, the terminal value, we got a value of 41,213,235. So we subtract 2 million from this, and we should get 39,213,235. We then input this as our cash flow 3, and then we compute from our calculator the internal rate of return. We get 22.1%. You should be able to get this. And then you look at the base case scenario. The terminal value for a base case scenario, we got 37,720,588. Then we subtract 2 million, and then we should get 35,720,588. And this is our cash flow 3 for the base case scenario. Again, we compute the internal rate of return, and this should be 18.31%. Then we do the final one. With the final one, 3, this is the downside case where we had the terminal value was given as 32,132,353. We subtract the 2 million, it's the final cash flow there. We subtract the 2 million and we should get 30,132,353. This is the cash flow 3 for the downside scenario. And when we compute the internal rate of return, we should get 11.68%. Okay, what you see is that for the upside, the internal rate of return is more than 17%. The question is asking whether or not we are going to exceed a target of 17%. We do exceed in the upside scenario. In the base case scenario, we again exceed. This is 13, so this is greater than 17%. So this will be 17%. The only time we do not meet the target is the downside scenario. We barely meet the target of 17%. We get 11.68, which is less than the target of 17%. And based on the probabilities, we have a probability of 25% of getting an upside. And we have a probability of 40% of maintaining the base case scenario. If you add these two, you see that we are going to exceed this. We're going to have an ARR greater than the target 17%, 65% of the time. So we are going to exceed this with a probability of 65%. So there's a 65% chance that we are going to exceed the internal rate of return target of 17%. I hope you managed to calculate this. If so, well done. If not, give it a try and make sure you get this. All right. Let's get on to the other question. The only tricky part here is just this part where the final value, you just have to add this terminal value. Because remember, the final value and the terminal value are discounted in the same time period, 3 here. Okay, let's go to the next one. I want you to give this one a try. Also, this is very, very straightforward, fortunately for you. Very easy. And this is the last one we are doing. So I want you to give it a try first, and then we do it together. Look at the first scenario where you built today. The construction cost today is 95 million, and the completed building is expected to be 115 million in present value terms. This is as straightforward as it gets. Today, which means if you build today, the value today should therefore be equal to this expected value of 115 million minus the cost today, which is 95 million, if you subtract these two, you then get the value today equals to 20,000, and this is dollars. This is as easy as ABC. Very straightforward. Okay, now let's look at the bit of the tricky part here. We have a probability that it will expand, the market will expand, and a 30% probability that the market is going to go through a downturn. You have time period 0 here, and you're going to have time period 1 here. Okay, let me put this here, and let me put this here. There's a 70% chance that in time period 1 there's going to be an expansion, and there's a 30% chance that in time period 1 there's going to be a down 10. With an expansion, the owner incurs 250,000 in property tax in either scenario. So whether we go up here, you have to pay tax. 250,000. This has to be paid in the first period for both scenarios. So whether there is an up 10 or a down 10, the taxes have to be paid. Okay, and then under the expansion scenario, construction costs are expected to rise by 8%. So again, another expense. 8% rise in construction costs, 95 million. So they go up, the cost go up by, and the value increases by 20%. So we have to add the 20% increase in the value of the building. So the value is 115 million. Okay. Now, if you solve this, an increase of 20% in the value and the cost 8% and the taxes, this in the downside scenario, the project is not built, so dollar 0 here. Okay. And therefore, to get the value of this project, in the instance that there is a delay, the expected value is going to be this probability of 0.7 multiplied by all of this, which is 1.2 times 115 million minus 1.08 multiplied by 95 million, and then we also have to subtract this 250,000. Okay, so you have to subtract this 250,000. Just make sure you write this as 1,000 with 3 zeros here, and here there are 6 zeros here. So remember, these are millions, these are millions, these are thousands. And this value, you then add the probability of 0.3 that there's a down 10. There's no building here. All you incur is a loss of minus 250,000. These numbers, you have to discount them back, because remember, this is 1 year in the future. So you have to discount them back by one period with a required rate of return of 17%. So it's 1.17 to the power of 1. And then if you solve this in your calculator, you must get a value of 20,966. If you look at these values here, is it going to be a good idea to do the project today or to delay? Clearly, the value of delay, you can see, is greater than the value of doing today. So what should you do? You should delay this project. Delay this. All right. So I hope you managed to do this. Like I said, this is straightforward. I was just showing you step by step so that you don't get lost somewhere. But the important part is that you understand how this is done. I want you to practice these 3 questions to wrap this up. I'm going to show you the questions just now. This is the first one. I want you to try and do this and see if you can be able to solve it. We're going to do these questions in the next section, but I want you to practice beforehand. That's question number 1. okay, where you want to determine whether or not you exceed the hurdle rate of 10%. The second one is this one, where you're going to use scenario analysis. You're given these probabilities. When you see a question like this, you might actually smile that your ancestors have remembered you or your God, because you know that it's not going to be that. It won't give you a headache. And then the last one, also give this a try. Again, it's a scenario analysis. I like these questions because they are nice and they help boost your confidence. You feel like you're smart when you do these ones. Anyway, we are going to do these questions in the next section. But for now, let me give you guys a break. I will see you guys in the next session. Mr. Mesh is tired. Mr. Mesh is out. Enjoy private real estate. Cheers.